Hi everyone. So today we're going to be looking at the Consolidated Statement of Financial Position question, which often occurs in the FAR exam, and it's a question that you can get lots of marks in fairly easily if you know the standard workings and if you know some other things. That's why I thought I'd focus on it. So this occurs where you're preparing financial statements to represent the group as a whole, and when I say group, I mean the parent and the entities that the parent controls, which are called subsidiaries. Okay, and subsidiaries often occur where the ownership of share capital is more than 50%. So the shareholders have, control because they can vote. They always win the votes basically. Associates, we say associates are not part of the group. Instead, the parent has significant influence over the associates. So if the associate is making a profit of 150k and the parent has 30% of that, then the parent will get 30% of the 150k. Okay? So at minimum, you have to prepare a consolidated statement of financial position. But within the question, they might ask you some other things like explain the single entity concept and how this applies to the statements you prepared. So I suggest you revise this, as it came up in the last exam, and I've seen it occur in other question bank questions. You need to apply it to the question though, so don't just regurgitate what is in the open book. Actually explain how it applies to the question. So just a reminder, the single entity concept basically means that we treat the entities within a group as one entity, as one company. Okay? And there are some standard workings that we can use for these questions. We'll go through those in a later video. Now, for the subsidiaries and the parent, I just want to explain that an easy way of getting marks is adding the assets and liabilities. So for group, you add all the assets and add the liabilities, and you need to make sure you leave columns for adjustments. Okay. Also, try and split your debtors and creditors from each other, your assets, liabilities from each other, and make sure you get some marks on classifying current liabilities, non-current liabilities, and current assets, non-current assets correctly. Don't forget to do the totals. Whatever answer you've put, at the very end, make sure you total up your figures. Or put in the formulae, actually, you can do that on the software. But play around with it and see what works for you. I'd say in your statement, leave as many spaces as possible because there are going to be additional balances that you haven't previously seen. So at least there's going to be goodwill. There might be an investment in associate, if there is an associate at all. And what can also happen as well is that when you're acquiring the subsidiary, there might be a contingent or deferred consideration. Okay, so contingent consideration is where you only pay money if the profits of the subsidiary exceed a certain value. So it's contingent on a condition, and that's measured at fair value. You can also get deferred consideration where you say, I'm going to pay the 150k in a year's time. So you delay the payment as much as possible. In that case, you have to factor in the time value of money and calculate the present value of discounted cash flows. So you first calculate the present value at the date of acquisition, and then you need to unwind that for any finance charge. Okay? And also in equity, there needs to be another line for non-controlling interest. Okay, and that occurs for subsidiaries. These are investors or subsidiaries who own it's where the parent owns less than 100% of the share capital. So there are other investors injecting money into the subsidiaries. Say if the parent company has 80% interest, the non-controlling interest will be 20%. Okay, now here I have in brown my group. Okay, imagine it's a circle. Imagine it's like a country. So within the country, you have the parent injecting share capital into the subsidiary, and also the subsidiary selling goods to the parent. Now for group reporting, imagine we're basically blacking all this out. We don't care what's happening inside the group. We actually care what's happening on how the group is interacting with other countries. So we think of it like how the company is interacting with its parent company. Not parent company, I mean how it's interacting with its external investors. So from an equity perspective, the external investors are going to be the owners of the parent company who are putting share capital into the group, as you can see from this diagram. So I initially blacked it out. As you can see, share capital is going to the parent, but even when we black it out, that arrow still remains because it's coming from outside of the group. The other equity investor is the non-controlling interest, and they're putting in money into the subsidiaries. Okay, so they're putting money into the subsidiary, but by putting money into the subsidiary, they're actually putting money into the group as well. Also, you have external loans on the outside, so your bank, lenders, etc., who are going to call the loans in. And if you think about it, the bank is going to be interested in the performance of the group as a whole, as opposed to the parent company on its own. On the outside, you have external assets as well, like cash, PPE, and client books. One of the reasons why you purchase companies is to acquire their clients, and when you're consolidating, you actually include assets such as client books at fair value. Okay. And also, just a point as well, you probably know this, but you must, for group, you add all the revenue together and add all the expenses. Okay. So one way of thinking about it is that when you're acquiring a company, you're getting additional, you're acquiring the assets, but you're also acquiring all the issues of the company. So that's something to bear in mind as well. And also I want to point out, as you can see here, the share capital of the parent company is equal to the share capital of the group. And that's because for NCI, we only look at movements post-acquisition. Okay, let's have a look at equity. So in terms of equity, as I said, there are two groups of investors. They're the owners of the parent company, who indirectly control the subs. And then you have the NCI, who are owners of the subs, but they don't have control. So to calculate consolidated retained earnings, we have to do the following. So we need to know the retained earnings of the parent at the year end. We add post-acquisition movement in retained earnings of subsidiaries. Okay. Now, this retained earnings figure could be replaced with equity, but the movements are generally going to occur in retained earnings. The reason why we only consider post-acquisition is because that's when the subsidiaries were part of the group. We don't care about what happened before they were part of the group. And when they were part of the group, the parent company had control over them. We also add in accumulated share of profits from the associate since the acquisition. So when for an associate, you're entitled to only a share of the profits, whereas for subsidiaries, you're entitled to 100% of the profits. Okay, so the accumulated share of profits feeds into this. And we also have some other adjustments that you're probably going to have to put through as a result of the question. So if you have impairment of goodwill, you're going to reduce your consolidated retained earnings. You could have impairment of the investment in associate, in which case you reduce this figure again. We also have to adjust for any intercompany sales of PPE and inventory, but we're going to understand how to adjust for those. From a non-controlling interest perspective, firstly you calculate the NCI at acquisition, and that's either using the proportionate method or the fair value method. You then add in accumulated share of profits, so the interest, that's based on the percentage ownership. So if the NCI has 20% of share capital, it has 20% of interest, so it's going to receive 20% of the relevant profits arising from the subsidiaries. We're going to look at statement of profit and loss in a later video. Minus impairment and goodwill. Okay, so for fair value method, you allocate some of the impairment to NCI, and in that case you take away impairment. Also for both, you take away dividends paid out. So, you know, there are two groups of dividends. They're going to be dividends paid out to the owners of the group, of the owners of the parent company, and then there are going to be dividends paid out to the NCI. So in both cases, you're going to reduce both equity accounts. Okay, now for investment in associate, I'm just going to put my arrow on so I can see more clearly. Investment in associates, that occurs where you have an associate and it's only one line in the balance sheet. Okay, there's only one line to represent that investment in associate. So we don't add assets and liabilities of the associate to entities in the group. Okay, so we don't have to include an additional line and add all those assets and liabilities. So there's less work. There's no NCI and no goodwill. Okay, so please remember these don'ts. I used to make these mistakes when I was tired. And I just want to emphasize that the associate is not part of the group. It's an external party. Okay, so you need to treat it like an external party. And to recognize an investment in an associate, we have the cost of acquisition. So you debit investment in an associate and credit maybe liability or cash. You then you add on your share of profit, so that's not the same as 100%. Instead, you add the share of profits. So if you have 30% ownership and if you have 50% ownership, no, that's not a good one. If you have 20% ownership and your profit is 300k, the share of profits is going to be 20% of 300k, which is 60k. You take away any impairment, but don't apply the percentage to the impairment. You just take away the full impairment of the investment in associate. Like if it's 10k, you take away the full 10k. You take away any dividends that the associate is paying to the parent company. Okay, so if it's 20k, you take away the full 20k. And if an investment in associate is paying dividends out, then that represents dividend income. So the group as a whole is receiving dividend income from that. And that becomes investment income. And that investment income feeds into your consolidated P&L. And then that indirectly then feeds into your consolidated retained earnings. So understanding how different movements affect the accounts is quite helpful. So basically there are two types of adjustment. They're the ones that eliminate intragroup transactions, and then there are others which we'll explain in the next video. Okay, but I hope that was helpful and I look forward to telling you more.